Two friends invested 1 lakh rupees each in mutual funds. One earned 14% and other barely made 8%. Both chose top rated funds. So what went wrong? The difference wasn't the fund, it was how they picked it. Today, I will show you 8 simple but powerful ratios that can help you avoid average funds and pick future winners. Welcome to my channel, where I make finance so simple that even your chaiwala can explain it. In this video, I will break down 8 important mutual fund ratios, not just what they are, but why they matters. I will teach you with simple examples. This video is perfect for beginners and even intermediate investors. So let's start. Let's start with the most ignored expense ratio. It's the annual charge that the fund house take for managing your money. If you invest 1 lakh rupees and the expense ratio is 2%, you lose 2000 rupees every year, no matter how the fund performs. Now think about this. If two funds give 12% return, but one charges 1% and the other charges 2%, your long-term wealth will be lakhs different after 10 years. For index funds, aim for below 0.5%. For actively managed funds, below 1.5% is reasonable. Now let's talk about standard deviation, a measure of how bumpy your investment ride is. Say your fund gives 10% one year and minus 8% the next year. The returns are unpredictable. That means high deviation. A fund with steady 9 to 11% return every year will have low standard deviation. If you are a conservative investor, this is your best friend. Beta shows how your fund behaves compared to the overall market. If the beta is equals to 1, that means the fund is moving like the market. If beta is more than 1, that means the fund is very volatile. And if beta is less than 1, that means it is less volatile. Let's say Nifty 50 drops 5%. Your fund with beta 1.2 might drop 6%, but your fund with beta 0.8 may only drop 4%. Choose beta according to your risk appetite. This one is very underrated. R squared. It tells us how closely a mutual funds follow its benchmark index. If a fund has R square of 98%, it behaves almost exactly like its benchmark. If R square is below 80%, it's doing its own thing. So if an active fund has R square of 99% and it's just copying Nifty 50, why pay a 2% fees? Better to go with the low cost index funds. Next is alpha. Alpha tells us how much better or worse a fund performs compared to its benchmark. If Nifty gave 10% and your fund gave 12%, that's a plus 2 alpha. If it only gave 8%, your alpha is minus 2 and you are paying a manager for underperformance. Look for funds with consistent positive alpha, not just one good year. This one is super important. Sharpe ratio. It shows how much return you are getting for the amount of total risk you are taking. Sharpe ratio above 1 is considered good and above 2 is excellent. Two funds giving same return, choose the one with higher Sharpe. It means you are taking less risk for the same reward. If you are someone who worries more about losses than gains, Sortino ratio is made for you. It only looks at a downside risk, unlike Sharpe which consider total volatility. So if a fund avoids larger losses and give decent returns, Sortino ratio will reward it. Sortino ratio should be greater than 1, which is a good sign for the safe players. Treynor is like Sharpe's cousin, but instead of total risk, it uses market risk, that is beta. It helps you compare funds with different beta values. If you are investing in aggressive small cap or thematic funds, Treynor ratio is helpful to understand whether the extra return is really worth the risk or not. You can check all these ratios on the platform like Grow, Zerodha, Morningstar India or Value Research. Returns alone don't tell the full story. Mutual fund investing is like a marriage. You need to understand the personality, not just the face. These 8 ratios are your pre-marriage investigation. If you found this video helpful, smash that like button, drop a comment with your favorite mutual fund, and don't forget to subscribe my channel for more no-nonsense finance in simple language. Until next time, invest smart, stay sharp.